Hello and welcome to Money, Money, Money. Having your own home, it's a dream that all of us have and want to realize. Of course, a big decision, a big investment, and the first step for most on this journey to that dream home is getting a home loan. And that's what this edition of Money, Money, Money is dedicated to. A simple guide to help you get the right home loan. Joining me on the show today is Rakesh Singh, CEO of Aditya Birla Finance and also Director of Aditya Birla Home Loans. Also with us on the show is financial planning expert and author of Yogic Wealth, Gaurav Mashruwala. Gentlemen, thank you so much for taking out the time and being here. I'll start by admitting this. I haven't taken a home loan. So it's going to be a very simple layman's guide to getting the right loan. But, to start off with the decision itself, and that's really important, how much can I afford? How big or how lavish a house can I buy, and how big a loan can I get? How do you go about making that very fundamental decision which is going to impact your entire financial planning portfolio?
First of all, I think one needs to really finalize what is the budget they're looking for, what kind of home they're looking for. And once you have finalized that, you need to reach out to your bank or your financing institution, check out what your eligibility is. And then you go about finding a house which is in that limit. So I would say that should be the first step.
Gaurav, do you agree when a lot of people are already doing their financial plans with you and suddenly they want maybe a second home or maybe their first home, then how do you go about rejigging the numbers to make sure that the burden is something that someone can bear?
Right. So first is what you pointed out is what we look at. Is it the first home or the second home, or is it that kind of upgrading? Because if it's first, then we are kind of little aggressive and saying if you're staying in rented premises, go ahead and pick it up. Now as a planner, when we decide that, okay, these are things, first of all, we look at their individual or that family, and are they like two of them, double income family, single income family, security of job, are they employable, experience. So these are the qualitative aspects that we look at. That's number one. Then when it comes to saying how much you can afford, as a planner, we look at two parameters. It's going to first affect your cash flow, your EMI. So usually we say that your EMI should not be more than 45-50% of your earnings per month. Now, if it's a first home, sometimes we allow them to go a little aggressive. And if it's two income, if they are employable, then little more. But otherwise, we say restricted to here.
Okay, so let me actually get in, Rakesh, on that, because this is the most important part, deciding how much burden can you actually take on every month. So when you're looking at giving out loans, I mean, first and foremost, as a lender, what is the criteria that you look out for in terms of the income statement? And also, for those who are salaried, at least there is a very clear demarcation of expenditure and income. What happens when people are self-employed or have business income?
So we look at the cash flows. So it's similar. So in the salaried, it's a straightforward salary income, which is stated in the salary slip. But for a businessman, you have to really sit down and understand his cash flow. What is his total income? What is the kind of monthly outgo which he can really afford? And that's what we really try and do it for self-employed individual. As Gaurav said, I think when it's a first loan, I think it makes sense to really go and take a slightly stretch, because you're looking at building an asset which is for long term, which is for the entire lifetime. In terms, at times, it's for generations. So you can really stretch. So if the home is for end use, you are saving on your rental income, you are getting benefit on the taxes. So I think you can stretch when it's the first home.
Okay, so let's get into some more specifics. As a lender, when people come to apply for a loan, what are the different criteria that you look at? What is the evaluation process which decides whether I get a home or not? And how much a loan I get as well?
So in a salaried, I think the monthly is much better way to do it. In a self-employed, because it's an annual income which we look at, because there will be seasons where he might not have any income.
Absolutely.
But in a season, he might have the cash flow, which is much better. So we look at the annual income, look at his trend, how he has been, and his cash flows have been over the last 2 years, 3 years, and then determine what kind of loan one can really
again,
give.
what is the math there? As you pointed out, and Gaurav also pointed out, that for a salaried individual, typically at least 40 to 50% should be the EMI of your total income. But again, if you're looking at an annual income statement for a self-employed person or a business professional, then what's the number? What's the number or what's the math?
So it can depend. See, at the end of the day, we look at the credit profile of a customer, and that really determines what is the loan amount you can really offer. But it can range anywhere between 5 to 7 times his annual income is what you can really assess as a home loan.
Okay, Gaurav, just the same point, extending that conversation, is it a little more difficult to plan when it comes to self-employed people, and it's such a big commitment of a house?
So as a planner, yes, because as he rightly said, the cash flow is not consistent throughout the year. So
there are lots of variables you don't know. I mean, especially with a self-employed professional or a consultant for that matter.
There are.
Yeah.
And to that extent, we also have to do internal management of money in a manner that there is certain amount of reserves available to service that EMI. It's very, very important because we don't want them to default. That's for sure. Also, in both the cases, we'll also look at the balance sheet. We'll ensure that, or we would want that the liability is not more than 50% of overall assets. Though here, first home, we can go a little aggressive, but these are the parameters. But professionals and more so business people, we also accept the fact, well, personally, I don't prefer that they would have an unaccounted money or cash income coming in. We have to accept that's a reality in India. So a lot of these people could be taking care of certain expenses through that. Now, while we don't like it, that's a reality. And if that is the case, then they can go a little more aggressive on the income and the EMI that they are servicing.
Okay, fair enough. Now let's talk about the loan to property value ratio itself, and how much is typically sanctioned out. So, what are the numbers and how do they range in metro, non-metro cities, etc.?
So, these are regulated in a way. So NHB has a guideline that you can go up to 80% of the LTV, loan to value, or 75%, depending on the ticket size. But one should look at from their comfort point of view. So these are the regulations which the regulator has put in. But one has to really, as Gaurav mentioned, through the financial planning, you should assess what is the kind of leverage you want to take it on the property. Yeah. So, but regulated is 80 and 75%.
Okay, we're going to take a break on that note, and then we kick off the most important debate. In the current interest rate environment, how do you go about structuring your loan? Fixed, floating, fixed versus floating? We'll get to all of those questions when we come back.